It's another exciting episode of Two Guys Against AI.
Well, this is your episode, if ever there was one. So let me start with a disclaimer for everybody, and this is an important disclaimer as we're sitting here. We are going to talk about artificial intelligence, and we will cover topics today like finance, the monetary system, investing, and I want to make it very clear that you should not take any of this as financial advice, investing advice. Heck, you shouldn't take any of this as life advice. This is two guys. I'm Will.
I'm Ed.
And we are just basically talking about what we think about the world and artificial intelligence. We are not telling you what to do. We are not telling you what to think. We are giving you one perspective for you to use in your own thinking, your own self-development. And it is true that at one point in life, I did co-author a book called Dollars and Cents, A Guide to Financial Security. And this book I authored many years ago. I even have to look up 2008. So right in the nick of time to save myself from the last financial disaster, the biggie of the Great Recession. But that is a book written for children. It is not a book that would give you financial advice. It is rather dated now. But that advice was to tell young kids, what is a bank account? Things that are lost from our education system. What is a stock? So it's really, really basic stuff I'm giving you there. So do not take this as financial advice. We are going to talk about what we're seeing from our own personal opinions and perspectives. And Ed has a different background as an economist with finance. So I'm going to let Tim tell you a little bit about himself to start this video. But also, again, he's going to tell you this is not advice for you to use in your daily life for monetary systems. It is philosophical thinking about what the future might hold.
And I have one other big disclosure, and it may come as a surprise to all of you, but I was not invited to Davos for the last meeting to discuss the world's financial future.
And in fact, your writings are very critical of the monetary systems that you did in your earlier days. So you have a very unique perspective. Over the years, I've probably moved closer to your perspective than my own. That I would have begun with. And this is part of why listening to different voices is important for people. Not so you know what stock to pick or whether to invest in bonds, keep cash, or go into the Magnificent Seven right now. What we're really about is telling people there are many perspectives out there, and a well-rounded person listens to numerous ones. This will be one of our longer podcasts. I'll also warn you that, because we're going to have to do a lot of explanations because the topic matter can be quite confusing, even beyond AI for many people.
Well, I think that if we go back, historically, money, which is a fungible object that is used for exchange, where like you can take something as a store of value and then use it for goods and services, is something that has evolved in many ways through time. Currently in the United States, we have a completely fully fiat system that's based on the faith and credit of the United States.
Now, when you say fiat system, explain to people what that means. Because I know it's a term you're going to use a lot here, and not everybody might not be aware of what you mean by that.
Right. So a fiat currency is something that's not based on its relationship to something that is fixed, so to speak. So, like, for instance, the United States in the Coinage Act of 1792 was a monetary system based upon a certain amount of silver equal to dollar. It was actually 0.715 ounces. And that,
not that you can remember specifically.
Yeah, just off the top of my head. And that amount of silver was something that was fixed. And what it did was it kept the monetary system from being diluted. Although mining, obviously, of silver would increase the monetary system in that respect, but it was tied fast. There was an intrinsic value to it. that gradually changed over time, starting with greenbacks during the Civil War. We started to have government was just printing paper IOUs that would be used as currency. Actually, we can go back because the continental currency from the Revolutionary War, when George Washington was faced with how to finance the war, issued continental currency, which ultimately was known to be not worth a continental. That was an early foray, and there were periods of time to where the United States flowed in and out between the silver standard, which went back from 1792 until 1965 with the Coinage Act, and then gold at times. It was bimetallic, and it was tied fast to where that was ultimately terminated through the confiscation of gold in 1933. Those situations started to lay the foundation for what we have now, which means the monetary authority, which currently in the United States is the Federal Reserve, writes IOUs out saying, well, we're going to pay you. And these have been used as an exchange. And the currency value was based upon, to quote the 1913 and 14 original Federal Reserve notes, redeemable at par, which means that it's worth whatever anybody will give it to you for. So as in my short time on this planet, relatively speaking to most everybody else, a long time, but I remember buying gas for 29 cents a gallon, and now we pay sometimes over $3, sometimes we've paid over $5. But there's nothing that ties it fast to anything that's intimately scarce, so to speak, which established a value.
So our system now is based on the gross domestic product.
Right. In other words, it's an exchange based upon goods and services, so long as the goods and services were at par with the amount of currency that was created. There was some relative balance that was established. Although once the United States became the reserve currency, which pretty much happened after Bretton Woods in 1944, we started to end up to where our currency was used for all international transactions in dollar.
And there's
form.
power in that.
Absolutely. And the limiting factor that the United States had initially was the fact that even though gold was not used domestically, the international exchange for U.S. dollars could be redeemed at a rate of $35 an ounce as a result of the Bretton Woods Agreement, and as a result, foreign countries were willing to take the U.S. dollars because it was a case of, I can redeem them for gold. But ultimately, you start to end up where the fractional reserve banking starts to come to play, because if you issue more certificates than there is gold in the vault, ultimately you end up with a default, which happened in 1971. We also had the changes away from silver, where the coinage, which originally was at 90% silver, changed in 1965, and we ended up with the copper-clad quarters, and now everything there's no tied fast to physical metals at all. So as a result, because humans are innately greedy, they started to print money with abandon to push political agendas and to finance wars and things like that, to the point to where,
in one man's opinion,
and
that
one
is shared
man's
by quite a few
opinion,
people, by the way.
And the fact of the matter is that we could take a look at historically, even if you want to go back to the expansionism of when Britannia ruled the waves was done with the British pound, which also diminished in value over time because political agendas, whether they be monetary policy, whether they be ambitious construction projects or people projects or war, costs money. And when you end up where you've spent more money than you have to come up with some way to debase the currency.
So let me try to simplify this and tell me what I get wrong here in your opinion, because I'm going to try to simplify what you said. The country is founded, all right? We got to get away from the British pound as much as we can. And I know you'll argue we never did. So we go to the silver-backed currency. Mm-hmm. So theoretically, for every dollar we put out there, there's a certain amount of silver held in reserve. So the money has value because there's a precious metal related to it. Eventually, that moves over to gold for a good period of time. But the world becomes a little bit more complicated after World War II with the reserve currency. So what we're able to do, because our currency becomes the standard around the globe. Now, the British pound is worth more, the euro is worth more than ours, but that everybody's currency value is based on the current value of the dollar.
It's pegged to the dollar.
Right. So there are some countries where they've actually just said we're the American dollar, even though they're a foreign country from ours. There's countries that have their own currency, but it's all, again, related back to what the value of the dollar is and its relation to that value, either higher or lower at any given point, usually based on how developed the country is or the conglomeration in the case of the euro. And then we have new entrants like Bitcoin. So I think one of the countries, I can't remember which one it is out there, adopted Bitcoin as its currency. So there's at least one country and it's a South American country, and I know I'm going to get it wrong if I try to remember off the top of my head. So I'll put it above me here, which one adopted Bitcoin, or if there's any others, I'll put the list there. Which I know you're going to go off on in a few minutes, Bitcoin. But the idea is there isn't gold behind any of this. There isn't silver. There isn't a precious metal. But there is production. So if I release money, there should be a relative production, gross domestic product, that goes out there that keeps that money valuable. And what you're kind of saying is, because it's not tangible and finite, the gross domestic product, decision makers of monetary policy can kind of fudge around with that, with what the value of the gross domestic product really is. And then you get things out there, and you'll see these out there. It's very confusing right now because you have all kinds of things happening in the first weekend of February with monetary policy, not the least of which is the creation of more dollars, the national debt growing at exponential rates. So I think we're at about 120% right now against our GDP,
yeah.
rather than 1-to-1 like we're supposed to be.
Even that's high.
Japan, who is the largest holder of American treasuries, I think is at like 280. I might be wrong on that number. And again,
Very high.
Very high. And they've been giving out money at zero interest rate. So if you're an American company and wanted to buy stock on leverage, you could borrow from Japan, and I actually believe a couple times Japan got to negative. So if you borrowed 1,000, you only had to pay 900 back, which is mind-boggling to me. But you could borrow that, buy stocks in the United States. They go up 24%. You made 24% on Japan's money, but Japan made nothing on it. They were counting on the U.S. treasuries.
Right.
Now they're pretty much bankrupt, which is fascinating, because if you're an older person, you can remember the Japan of the 90s. There was a guy that I really loved called Jim Belasco, wrote a book called Teaching the Elephant to Dance, and it was all about Japan buying up the United States assets and how we had to increase our productivity and get back to be competitive. And we've surpassed Belasco's ideas of that book, and Japan has fallen in the meantime. But as Japan deals with its currency in the next week or so, it could send shockwaves through the monetary system, where I think your argument was, when we were on a gold or silver standard, that couldn't happen because there was finite material. Am I correct in understanding?
The ability for governments to create additional monetary units to finance whatever the project du jour or policy du jour would be was somewhat limited. So let's look at this from a different perspective. At a time when coinage was the coin of the realm, if we wish, there was a given amount, and it doesn't matter whether it was wampum or gold or silver, but it was something that was not easily obtainable, or we could call it unobtainium as a term, and that it could not be created out of thin air. So you didn't have the ability to dilute the currency. Certainly, there were even examples during the Roman Empire to where, like later, they started to change the contents, by diluting it and shaving the coin size down, and different things such as that. We changed, took the base metals out, and made copper-clad coins. But I think that the major difference here is that it couldn't be increased dramatically. And with the advent of notes, a note is an IOU. And it says basically, and U.S. currency, silver certificates, which were actually issued until, early 1960s under the series in 1957, just a point. They were redeemable in silver. You could take that and redeem it. There were gold certificates that were the same way. So they were limited, if they were honest, that they couldn't issue more certificates than there was silver in the vault to back it up. But
if they did, the world kind of understood, and there was a problem.
Right. So, but because using the model of fractional reserve banking, where like you hold one down under here and you issue 10 certificates, don't you worry, we're going to make good on it. Eventually, it got to the point to where there were so many certificates out there that there was no way for them to be redeemed, which resulted in Nixon closing the gold window in 1971, and ultimately. The silver went away too, because we were no longer able to redeem all of the currency that was out there pursuant to the promises that were made on the certificates.
I wonder about that on some of the gold on stock exchanges rather than the physical gold you might hold in your house. So is there really gold to back some of those?
Well, and that's a good question. And there's also a lot of gold and silver certificates out there by private entities. That's an issue that many people would argue that there are more certificates out there than there are ounces of gold or silver on the planet. And that the difference between, whether you have a piece of paper that's a promise that they'll give it to you if you show up at such and such a place, as opposed to whether or not you have one in your hand, there's an issue of faith there.
So let me ask you, and I promise we're going to get to the AI, and the AI is going to make this, if Ed is correct in some of his assumptions, this will make the AI this is where AI could get extraordinarily dangerous in the economy, yes, in my opinion. But let me I want to cover a couple other things, because again, we have historical things that have happened, and I want to put some of these into the record here, so when we're kind of talking about, and again, you should look at this conversation like you overheard two guys in a barbershop in some ways. Do not take this and set your financial future on it. Make your own mind up. Right. Do not go by what we say. But here's one of the questions I have. You had this standard of gold, silver, but the one thing that people always kind of go back to, and I've seen a lot of, I've been watching, to get ready for this, a lot of YouTube right now. So I'm seeing a lot about Japan. I'm seeing a lot about gold. I'm seeing a lot about the Magnificent Seven. I'm seeing a lot of things about, Warren Buffett is going to move things to cash. You're seeing a lot of speculation out there. And you can't speculate the market because nobody's ever right to the day. But here's kind of one of the things I wonder about when you talk about, and I hear other people besides you make these arguments. Explain to me then the phenomena that happened in, I guess it was the Weimar Republic before, and it gave birth to the Nazis. And that's the old story we hear about. They produced so much currency that you literally needed a wheelbarrow full of cash to go get a loaf of bread. How did that happen if we were on one of these gold standards?
Well, I think you have to look at the difference in the fundamental philosophy here as to whether or not you are a nation or a people of debtors or savers. So many people say, oh, well, if you used a metallic system, just to use an example, that, we wouldn't be able to handle the increased activity that would take place. But what would happen then is that the value of the money would actually increase because it would not, there wouldn't be as much of it.
The buying power.
The buying power. So if you were a saver and you had
So it would
money,
keep inflation in check.
it would actually have deflation. There were periods in the 1800s after the Civil War where there was actually deflation, and it happened because there wasn't enough of the money, so to speak, because it was more valuable. So goods and services actually cost less in the monetary unit than they did in a case where inflation. So let's take another example. If I took and put $100 in the bank in an inflationary scenario where the power of the money got inflated or devalued through monetary creation, then what would happen is that my $100 would only be able to buy a lot less. Gas may have.
All right, so I hear
20
this
cents,
one a
right.
lot, and I'd love for you to kind of speak to this for a second about the inflation. And I know. All right, so I got kind of a classic example out there would be, and I'm giving regular people example, or at least I'm trying to give regular. So you've done everything right. You put your money into your 401k throughout your life. You have $500,000. Well, we'll use the magic number everybody wants to have. You have $1 million in this 401k. You're getting towards retirement. You don't want to be in the speculative stock market. You move it into annuities, bonds, etc., something that's considered more guaranteed, or traditional treasury notes are kind of always been considered the gold standard for this. And that's supposed to be the safe bet when you move your money in there. All right, but let's say...
As a store of wealth.
Yes.
Yes.
Let's say for a second, to just understand this inflation, and one of the things that always confuses me about the concern people have, so I'd love to hear from you, is, okay, I have this $1 million. It's 10 years before retirement. I put it all into the money market, all right, which is considered probably the worst investment long term. I put it into the money market. Inflation goes up by 4% a year. The money market fund gives me 2% a year. I'm not keeping up with inflation at that point. But neither is the vast majority of everybody else. So if my million's only worth $800,000, but my neighbor's $100,000 is now only worth $80,000, I'm still in a much better financial position than
Well, relatively, yes. But let me give another example. I bought my first house in 1975, and it was $29,000. I challenge anyone to go out and find a house for $29,000 today. You're going to be hard pressed to find one for $200,000. What happened there? In fact, you can actually, there is a website where you can go on and put in the date of what the value of your money was, and then do it to today and find out what the conversion value of that. It's very, very enlightening in terms of realizing how the purchasing power of our dollars have depreciated over time. And it happened because there was virtually no mooring, so to speak, in terms of the establishment of the value. And this is characteristic of many fiat currencies. Whether you look at the English pound, it used to be worth close to $5 US. Today is not. And we look at, everything is pegged to the dollar, and you look at the dollar and you say, oh, well, it's still, the dollar index is still up around 100. But we're almost like in a competitive race for the bottom to see who can devaluate the currency quicker. And where this starts to happen is that we lost something that was tangible. So let's start to bring this into AI, because I think that this is that's what we are, and probably the first most obvious example that people have of digital currency has to be Bitcoin.
Okay, yeah. Well, it's certainly the most common.
And we're told, and of course, everybody has their opinion, but we're told that there's a magic formula that makes it to where Bitcoin cannot be created out of thin air and have its value diluted. In fact, that it's supposed to be able to increase in value, which actually, if you look at it from the very beginning, it's gone up substantially. But we've also noticed, if you study Bitcoin over a period of time, that your value of Bitcoin probably went to a high of over 120,000, and then now it's just over the past
Well, just
week
in the
dropped down
time
to 60.
we've
Yeah.
been doing this, we mentioned Bitcoin once. I
Yeah.
think it was probably November 25, maybe October. I can't remember the exact date, and it was well over 120.
Right.
And I remember sitting here when you brought it up, thinking, "Man, I wish I'd have bought it at 60."
Right.
All right, it's first weekend in February 2026, less than 6 months later,
It's in 60s.
and it's in the 60s.
Yeah.
So for me,
And
It's
now
exciting.
and shot back up to 70 in a very short period of time.
so your argument is the ability of this currency, I'll call Bitcoin currency in this case, the ability of this Bitcoin or the inability to be stable at all and to have that kind of swing is the problem.
That's a problem. So, like, let's take an example. Let's say you're a forward thinker, and we've got a lot of digitally oriented people who are probably definitely into the digital currencies, which I get. I mean, it's all part of the whole computer mentality. That's why we're here. But Will, the thing that's happening here is that if you're going to get paid, now let's say the board tells you, what, you're going to get 2 Bitcoin a year. And that translates into $250,000. And then you find out, here we are a few years later, and you're getting 2 Bitcoin a year because that was the deal, except now it's only 120 and you just lost half of your salary. You can't have a monetary unit that's going to be used in commerce that people are going to take with the presumption that it's going to be a store of their value when the goods and services that they sold at a price today can be worth half that in the future. That's makes inflation from the dollar scenario pretty obscure, and we can assume that the trend is going to continue. Maybe Bitcoin will come back, but you can't have, as a successful medium of exchange, a unit that fluctuates by 50% in short periods of time. It's just, there's too many market
But
forces.
we do have it.
We do have it, and
You say we can't, but we do.
we do, but I guarantee that a lot of those people who were saying proudly we'll take Bitcoin for services are having second thoughts about this when they find out that the goods and services that they could have done for dollars maybe only went down for like 10% during the period of time that the Bitcoin went down in 50%.
All right, let me devil's advocate you here for a
Okay.
second. Because I think, here's the funny thing. I think you and I, from a foundation standpoint about the monetary, we differ a little bit and in our perspectives. And, it's interesting because it might, in fact, be, I wonder how much of this stuff is actually generational. Because you're gold, I'm GDP, young people seem to be moving to Bitcoin, and we believe in it. And here's where I'm going with this. Because I think when we get to the AI, regardless of what your foundational belief is, I think the threat is still the same. And here's what I'm going to say. And I'd love to hear your perspective on this. Gold has value because we've agreed it has value. Could have been fool's gold. We chose gold, and we all agreed.
Because it's difficult to obtain.
But it could have been any rare material.
Wampum was
Yeah.
a great example.
But then it wasn't.
Well, true, but
if an alchemist comes along and we're able to, we're trying to do these replicator machines and everything else, and you can produce gold,
yes.
you would agree that becomes immediately has no value if you can make it in a machine.
Well, that would seem possible, although to this point we're still wondering whether or not that'll happen. But
But here's what I'm saying.
Yeah.
It has value because we agree it does.
Well, and
No, let me finish.
All right.
GDP has value because the world got together and agreed it did.
Mm-hmm.
The American dollar has value because basically after World War II or at the closing of World War II, when we decided there'd be free shipping, free air, peaceful, you're not allowed to attack other. I mean, and people always say, well, let's go to the Vladimir Putin and Russia. Think back a couple of years when he shot a commercial airline out of the air. It was the National Transportation Safety Board that went into the Russia and did the investigation on what happened there. Because we control the airspace. That's why at every airport they have to be able to speak English. Every pilot has to be able to speak English. Same with shipping. We said we're going to have free trade around the planet. Didn't it make sense then for the GDP? Because we all agreed that the GDP would do it. It was an agreement. Just like it was an agreement for gold, And in some cases, as we move forward, if all young people going forward agree Bitcoin has value, then it does have value because we've agreed upon it. The same way I'll argue if at some point AI takes over and monetization as we know it, because it can't be based on the gross domestic product at that point, because it's being produced by a limited number, it was being produced by machines with limited people getting an income because we've replaced ourselves with this artificial intelligence. It can't be GDP, I'll agree to that, but it'll be something we agree upon. Maybe it'll be likes on Facebook.
Well, that's very possible. I mean,
That'll be currency.
Social credit score.
Yeah.
But
Doesn't it come back to we all just agreed at any given moment in time in history?
And it's I believe in hard currency. We're not there right now, and I'll look everybody right in the eye. You can watch the fluctuations in the price of gold has gone up and down and up and down, and silver dramatically. Here we are in the first week of February, just watched a dramatic increase in silver up and down, and we're going to be talking about market forces there and how AI plays into it. But what happens is now, because it's difficult for us to be able to pinpoint exactly what it is worth, you're right, it's an agreed value. But there's no dark curtain, so to speak, when you're looking at where the precious metals come from. And there's another thing that precious metals offer, that there is a utilitarian value to it. You can use silver, for instance, is a great conductor of electricity, as is gold. It doesn't corrode. So these noble metals, there's a consumption component to it as well, to where silver, in particular, as we're talking AI and electric, copper, for instance, which is used for wires as a conductor, these elements that have to be mined, and they're mined at significant expense, result in a certain amount of given effort that has to be done to produce them. When you're talking about having, an interest in metals that, you may store or you may have by certificate and stored in a warehouse, they have an industrial value as well, and evident by the fact that there were numerous industrial individuals who ran out as silver started to shoot up here, and we're talking like over the last couple months, where think of the impact of the cost of production from when silver went from $40 to $125 in a matter of a month and a half, and that's one of your major components of the product that you produce. Not to mention the fact that physical silver became ultimately unavailable because it got bought up. And we look at the COMEX in the United States, and Shanghai is another large commodities index, that predominantly work on paper futures, which kind of goes back to your certificates, your gold and silver certificates. And there are those who surmise, and again, I wasn't invited to Davos, but that there are more gold and silver certificate ounces out there than there are gold and silver ounces that exist on the planet. Part of that, when we start to look at the market forces, and I'm just going to use the precious metal market because it's very easy to trace. You can all go online and you can see historical prices. What causes those types of markets to move dramatically? Because what we certainly know is that if we look in the last week, when silver went from 125 down to 75 in a matter of like 48 hours, there was not a lot of silver that changed hands, obviously, but there were probably a lot of silver contracts that changed hands, and those certificates, just like IOUs, can be printed, and they're worth exactly the value of what they're printed upon, based upon the faith that you will be able to exercise those contracts. The worst nightmare is for those who have issued all those contracts that don't have the silver sitting in reserve in their vaults to be able to cover them.
Yeah, they're looking for the AIG bailout.
How is, and you can't bail it out because if they've got more certificates than there are ounces of gold and silver on the planet, they're going to have a difficult time being able to come up with it, bailout or no bailout. So it comes back to, what is going to be the way, and I know a lot of people will say, well, how can you use silver as money because silver just gyrated up and down? But let's look at the long-term trend here, because I think that's the thing.
Well, I think what we can say right now, whether it's the S&P 500 at an all-time high,
yes,
whether it's Bitcoin that was at an all-time high and then now is back.
But still
Halved.
significantly higher than when it started.
Halved, yes. Gold is, I believe, again at an all-time high.
Mm-hmm.
It hasn't fallen. Silver has. Silver was up,
Mm-hmm.
wasn't all the way there. Now it's down.
Right. But it's still $75 an ounce today.
Yeah, so it maintains some value. For me, whatever it's based on, whether it's digitally mined, massive amounts of energy used to produce Bitcoin, so I guess it's finite. I mean, I will not claim to be an expert in Bitcoin. It confuses the hell out of me. All these things exist, and so does AI.
Mm-hmm.
And we talked before about, I can't remember, was it 0.016 amount of the internet we can affect what people are thinking
Mm-hmm.
With this artificial intelligence. And regardless of which one you're invested in, it seems like to me right this second, there's an AI factor in there. Why do I mean that? Because I went to look at this stuff, and if I go on YouTube right now and I search out these things, I'll start to get a lot of videos put into my feed. So I look at, and I noticed that I got a lot of cartoon videos, much like cartoons like this, because you use cartoons because it's easier for people to understand. They're not afraid of cartoons. So these cartoons are coming on, and they're telling me about 2026 possibly being a 2008 kind of crash. Like the message just keeps coming to me, and here's where I get concerned. I'm not getting alternative messages because of the way the algorithm works. It's feeding me over and over and over again fear.
Whatever
But right now it's feeding me fear.
Right.
That's the rabbit hole I've gone down is clearly whatever I plugged in and whatever I started watching, it's plugged in fear. These videos are designed to make me afraid right now,
Mm-hmm.
and they're AI generated, right? And I actually have 4 coming in now that are basically the same cartoon with a different AI voice behind it.
Mm-hmm.
And what I'm thinking is, man, if I am an adversary of the United States, let's say like communist China, and I want to really take on the United States, one great thing would be if everybody got sick and couldn't work for a while and went to their computer and were stuck in that environment. So they really got addicted to the YouTube and social media because you couldn't go out of your house because of this illness. Then I could have my people developing this AI and pushing it out there, knowing that understanding the algorithm better than the average user. Now I create fear and speculation within the reserve currency because it's in my best interest as a nation to become the reserve currency. If I can crash this thing,
You win.
it's power.
So
It's geopolitical power.
So I did to just back up just a little bit.
Which brings me to you. If you had to have gold, no one would have that power over you.
Well, because it's not something that's created. Let's just back up for a second though, because I think you brought up an interesting point. Yeah, stock market's at 50,000, and we're talking. This is February 2026. Stock market's at 50,000. Stock market used to be 2,000. A dollar used to be 0.715 ounces of silver. Now, 1 ounce of silver, $75, probably somewhere around $60 if we were to talk. So it's like 60 to 1 change. Or gold close to 5,000. Originally, a $20 gold piece was 0.965 ounces. So all of those have gone up. Stock market's gone up. Bitcoin's gone up. Everything's gone up. Why has it gone up? Because the indexing is done in dollars. Has it actually gone up? That's the question. So let's just look at that for a second. The only reason that the stock market is 50,000, the only reason that gold is 5,000, that silver is $75, that a house is $50,000 is because there's that many dollars out there to be able to buy them, because there have been so many more created. This is why other countries look at the reserve currency, because when you're used as the reserve currency in the medium of exchange, you can actually force your
We can set
currency
the
unit
rules.
to be used. Yes, you can do it militarily even. So what happens?
You mean
is
like
that-
going into somebody's country and taking out their leader in one night
There you go. So
for a finite element?
there you go. So when we look at that change, it's that there's an excess number of dollars out there. The goods and services are the same. If you had that savings in gold, for instance, that even when it first became available, it was like $50, and you put $50 into that gold in the 1980s. Today, you could get $5,000 for it. So unfortunately, I missed that trade. But it was a preservation of wealth. And also, you were buying gas in the 1980s for in under $1 a gallon in some places. And now, you're looking at it significantly more. So it's not that it really went up that much in actual value, but it was whether or not it preserved the purchasing power that you had.
Because of the inflation.
Because of the inflation. And the inflation wasn't through the increase of the amount of gold or silver. The inflation is because there's an increased number of dollars. So let's, look at the same.
Because when we create more dollars on low interest rates
Right.
and push it out there,
Yes.
there's only one thing that can happen. Everything becomes more expensive. And when we say we're going to give you a $25 minimum wage, the trick is your $25 is worth what $5 was years. You didn't get a raise. You just got a larger dollar amount to pay for what you used to pay for the same thing.
My economics prof, and he's long since gone, but I would say he was probably my mentor, which is ironic because he's a Keynesian and I am not. But he used the pie. So you got a pie. Grandma just made a pie, and each of us got $1. And there's 6 pieces of pie. Now Grandma makes the next one, but everybody's got $1.50. So because everybody's got $1.50 and there's still only one pie, now it's $1.50 a slice.
There's no more pie.
There's no more pie. The pie is the same. So all we've done is we've made it to where we could give more of what's out there. But at the end of the day, Grandma only made one pie.
But here's the problem you're leaving out, which I think is where I'm most fearful of the AI and the impact. And I'm going to start asking you some questions directly about AI. The second pie Grandma made, right? And now everybody can afford to pay $1.50. So I'm going to outbid you because I really want pie. But now there was 10 grandchildren and 10 pieces of pie, but there've been a couple added.
Now there's 12 grandchildren.
Yeah. So there is less pie.
Yeah.
So you get less pie for more money.
That's what we're looking at. And
that's probably the analogy we're in, right?
We're getting there. And
except this can all be manipulated by AI because it's not tied. But we all agree X is what the currency is based on. Right now, it's still the GDP. I guess if you're in Bitcoin, it's in mined coin. If you're in gold, it's gold. We all agree. But the AI can influence what our perception of that agreement is and change the value.
First of all, through Madison Avenue style of manipulation, which you just talked about, where there are a few different individuals providing economic advice, if you will, and of course with the same.
And it's not us. It's not us.
Same disclaimer as Two Guys Against AI. What we have is that you have a change in the perspective, whether or not you have confidence in your currency or you're afraid of your currency. If currency is inflating quickly, people will tend to spend it faster to buy at prices before they go up, which tends to superheat things. But also, I think we have to look at how AI can affect the markets just through the actual action of the market. So let's say you trigger fear
Which I think is what's going on.
Which is what's going on. And, we can have, Dr.
Well, that's all it
Doom.
takes to drop the stock market, the gold, the Bitcoin, is I get afraid and I start selling, and then my neighbor starts selling, and we all just start selling at once, and no one wants to buy.
And we're looking now, and I'm going to use this silver phenomenon, I'm going to call it, of 2026, because we had a dramatic upshoot and then a dramatic fall, and where it's going to go next week, nobody knows. But let's look at how that can happen and why AI, in its speed of computing, becomes such a significant factor. And we're still talking on the market side. We're going to get to another side of this too, which is the manipulation and a new feudalism.
But humans can do this manipulation too.
That's true. But what we actually have is a case where the monetary unit that's being used, that people are, getting afraid of, we do everything in dollars. So let's say I just made a home run and I had bought a bunch of silver at $50 and went to $150. And I put in there, you know what, I'm going to take my losses. If I'm at $100, I'm going to put a sell order in there, and it's going to be executed by AI. And there's more and more of our stock brokers. I know Vanguard in particular has sent me numerous solicitations to use their AI stock service. What it does,
Vanguard, who is telling their investors, move from your 60 stock 40 bond to 60 bond 40 stock. Because even a Vanguard, what is it, 11 trillion, I think? I mean, if Vanguard moves money, it changes the stock market. It's because of the volume.
And they have the ability to be a market maker, which is frequently the term that's used. But let's look at how AI plays into this. And we've talked a lot about LLM, large language models, and its reactive nature. So the command is...
Well, let me give a human example first, all right? Because I think it'll help you. So I had to get ready for this episode, and I knew you were going to talk about gold and silver, right? I knew you'd come back to it. So I said to myself, let me go out and see what it takes to actually buy physical gold and silver.
Mm-hmm.
All right. So I called one of the companies. I'm not going to name the company. All right. But I called one of the companies and I said, I'd like to buy some gold or silver. And not ever having done this before, I said, what do I need? They go, an entry point with our company to ship you this physical gold and silver, because I didn't want to buy notes because I didn't know if it would be real. So like, how much would it be to get you got to start with $5,000, all right, minimum. And I said, okay, for $5, I get an ounce of gold. And this is what the person on the other line said to me. Right now, I'd recommend silver. That was when it was at its high. This was like last week. If I had bought it, right now I'd have lost half my $5,000.
Correct.
Because did that person know something?
Well, I think the first thing is we can look at moving averages. Anytime you look at something that's dramatically above, and then the other thing is the gold silver ratio is something that traditionally has ended up somewhere around 50 to 1. So we have some parameters in terms of like when the relative value is, because if the one goes dramatically up, some people prefer gold because it's it's smaller. And these are all things that can affect the market dramatically. But the thing is, the cascading effect happens because, let's say AI is the one who's actually doing the sale. It gets a sell order at 100, and we're going back to my earlier statement.
Well, this is my point. My point is, if one guy can do that,
yes,
what could AI do across the vast
Absolutely.
internet?
In terms of being able to create the market and drive people to make purchases based upon the AI perception, which we already have discussed that AI doesn't.
AI lies and manipulates.
So what happens in a situation where this takes place? So I have a sell order. I'm going to cut my losses. I bought it for 50. If I could sell it for 100, if the price comes back down to 100, I'm going to say sell. What happens when everybody said sell? So what's the order to AI? AI was told it's 100, you put it up for sale. In split seconds, it makes decisions and found out it failed at 100. Well, maybe it'll sell at 99. Maybe it'll sell at 98. Maybe it'll sell at 97. And you have this happening across the whole market. We
I
talk
think this happened in the
2008.
early, but it also happened. There was that time in the '80s when they automated all the stock market. I can't remember. I can't remember. It was like it was. I think it was like the mid '80s. They had automated the sell orders, and people were just sitting at home. They wouldn't have sold if they were thinking about it. But all of a sudden, the computers they didn't use them after that. Started just selling this stuff off like crazy and tanked the market. I remember that. I can't remember what year that was.
But and that happened again in '08 too. But what happens is the machine had an order to sell. So that sell order said sell, 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 sell. It didn't get told necessarily not to sell below a certain point. A human would look at this and say, hey, you know what? When this gets to a point where it's down that low, I'm going to ride myself out. That wasn't an option. No, it continued to fall. And that's where you got the cascading effect. Now, if you add into that, what happens if those paper certificates that are owned by clearinghouses who are really nervous about the fact that they don't know where they're going to come up for the silver that was selling at 125, you take all those certificates, dump them into the market. AI doesn't know the difference because this guy's saying he'll sell this for such and such a price, and the price can tumble down again. So we're seeing that there's a lot of manipulation that's taking place that wouldn't be happening in a bourse where you'd be coming in with product and selling it for product, which is one of the reasons why when you buy physical gold or silver, you pay a premium because there's a lot involved in that. You know, you're going to have shipping and handling, and they've got to be able to come up with it. Another interesting thing is that when silver was at 125, there were no buyers. So how could it actually be at 125 if there were no buyers, other than the fact it was a fictitious number at 125? And, you know, if you couldn't get anybody to buy it at 125 because they were like, I'm not buying this at 125 because it's way over the 200-day moving average, what happens? AI said, I had a buy order. The buy order said, I'm supposed to buy at 100. Well, nobody's selling it. Well, now what do I do? It goes to 1.5. It goes to 110. So you're looking at these dramatic things can happen. And it's not even real in terms of what it is. Even when we look at Bitcoin, I watched Bitcoin drop $10,000 in a day. What actually changed hands? Nothing. Nothing changed hands. A bidding war was taking place of people, buying or selling based upon the fact that there was going to be a buyer to match the seller. The market actions, when it's working in a vacuum, it actually can break things very, very quickly unless the command is specifically within a parameter. And buy means buy. And if you go out and you buy and there's nobody who's got a certificate out there that wants to sell, the price is going to go up. It didn't even matter because I contacted, people. I'm thinking to myself, gee, maybe it's time for me to liquidate. And I got told the refiners didn't want to buy it for those prices because they know it's going to go down. So those are AI falling points, or I should say failure points, indicators that the market no longer is real because a lot of the major presumptions don't take place.
Your point is AI is a bigger threat to the way we're currently doing currency than anything to come before it.
Because it happens so fast.
Let's stop here. Listen, if you like these videos, this is going to be a two-parter because of the length. If you like these videos, if you could subscribe, like the video. The subscription is free. We don't have any products to sell you afterwards, but if you're enjoying these, you'll hear about new videos. You will not hear us say we have a pamphlet for you to buy. We have a newsletter for you to do. This is just two guys against AI talking about some of the threats that are coming down the road, and we hope you stick with us. Not necessarily that we're right, but just to come along on this journey with us to asking questions before we just make assumptions. We'll see you in the second half of this video on AI and the current monetary systems.
Ahmed, that's Will.